UK wage growth has slowed, which should have a broader impact on inflation. We're going to find out what the effects of that have been. And gold, we said last week that following that big move higher would have been a bit of a fool's game. We're taking a look at the market because it is $70 lower from when we made that call. And the trade in takeout today is going to be again reinforcing the concept of surprise and relativity. This is all that happens in macro markets. Before we get into today's video, though, make sure you hit subscribe and like this video so I pop up in your YouTube feed every day so that you can maintain your trading edge. UK employment data and wage growth data came out today, and the employment data was rather boring. It was all bang in line, basically 4.2% versus expected 4.2%, previous 4.2% as well. God, that's dull. At least do something, But the UK earnings is probably the key bit. Now, the quarterly earnings for, the months leading up to October was 7.2% versus expected 7.7%, with the previous at 7.9%. Now, that's quite a considerable change or difference from expected and even versus the previous as well. And what that has caused now is the Bank of England, or the market, to actually price in a cut. So a cut has now, or bring forward a cut. A cut has now priced in a 25 basis point, the OIS, which is the overnight index swap, has priced in a 25 basis point cut for June next year versus August yesterday. So it's brought it forward by 3 months, which is quite considerable. Now, I would argue that this is very variable. It shouldn't necessarily occur just off of this data point, but we can see the trajectory. I think that this is slowing pretty considerably. And if we combine that with house price slowdowns as well, we are seeing the effects of interest rates really start to filter through. I don't think we've even seen about a third of the effects just yet, which is terrifying, really, right? Because they're quite lagged. They're lagged by, in some cases, like 2-3 years. Bear in mind, we started hiking in 2022, at the start of 2022. So we're coming up to that 2-year period now. And so, now we're starting to see those cuts get priced in, but they've still not cut yet. The data hasn't deteriorated sufficiently for any real validity to be put on the idea that interest rates have fully fed through yet. So this is where we are positioned now. We are looking at, rather than hikes, which was, I guess earlier in the year, the whole of 2022 was hikes. We're now looking at when the cuts are going to start. And so this is an important regime change to really, really focus on now. To what extent are these cuts going to get priced in by the market more and more aggressively? Because it's going to be a totally different environment when cuts do start to get priced in, at least in the shorter to mid-term. In the longer term, they're priced in, and we're going to get onto the importance of pricing in and surprise on the trade and takeout today. But just keep that in mind, that we are approaching a regime change, and things will change considerably from how you've been looking at the market over the last year or two. So gold, a very interesting market over the last week or so. And I think just check out this quick snippet of what I said last week with regards to gold. So the biggest move of the week outside of crypto, which we're not going to talk about because of certain regulations, but the biggest move overnight has been gold. To me, it looks like a really low liquidity fat finger. So someone's accidentally gone and bought, maybe 10, 100 times more than what they wanted to, because that is a completely anomalous move. It's moved up over $100 there. Over the space of, not $100. It's moved up, nearly $100, actually, nearly $100. So ridiculous move. Looks like a fat finger. And of course, you can see the market's being completely faded there. I've said today already to some guys that chasing a move like that when it was a lot higher fear of missing out and that kind of thing is where you're going to go wrong. And subsequently, it's about $30 lower from where I said that. So it is what it is. If you see moves like that, especially in overnight conditions and not during the main trading sessions, you can tend to deduce that someone's done something wrong, whether it's an overnight intern or something like that. Someone's on the chopping block today, basically. That's pretty much what I'd take from this gold move. There's no macro drivers from it. There's nothing going on necessarily there. So wouldn't take too much from it. Lots of people have been reading into it. To me, it looks like a massive fat finger. Someone is either losing their job or is going to have to make up their P&L massively for, the year's nearly done. So maybe they've got a couple of weeks left, 2 weeks or something to make it back. But yeah, it doesn't really look like anything substantial to me, anything with substance. So ignore basically that gold move. From there, we are now trading about, $60-$70 lower from where I said, ignore the move higher. And I don't know if anyone decided to jump in there, but there tends to be a reflexive thing in markets whereby if you do get a broad move like this and it fades, it goes a lot further this way than you'd first like to think, I guess. The fact that this was basically a fraudulent move and it's taken out some serious highs, like serious multi-year highs there, means that gold is probably going to get faded quite a considerable amount lower. I would be suggesting down to levels like here, especially now that inflation is easing. We're seeing the disinflationary effects now go, and I think people are getting very, very bullish gold. When you tend to find that people are getting bullish an asset to the exuberant levels, something's got to go and something's got to cause another pain trade to take them out. So I believe this is what we've seen over the last week or so. As we've seen, that over exuberance, which I think was actually a fat finger, definitely a fat finger almost. And then we're seeing that reversion now. We're seeing that pain and those stops get hit. But do bear in mind that a broader move lower is suggesting something about inflation. You can see here that through 2020, through 2023, basically, when inflation was ticking much, much higher, you can see the effects of what happens with gold. People are hedging their bets with gold. Now we should see a reversion of that move. I would argue that we could see by the end of next year back down to 1600. So bear that in mind. Everything's a macro trade on longer time frames. That is, shorter time frames, it's very much positioning and pain dominant. But on the longer time frames, what you need to focus on is the data and how far the data is moving. So let's get onto that in today's trading takeout. Now, today's trading takeout is effectively how to understand that the market is just a series of relative changes versus previous. It's a series of surprise, and that is what people are looking for. So on the previous gold trade, for example, that we mentioned, that is really just looking at the extent to which inflation perhaps is slowing down globally. And now we're looking at the reflexivity on the way back. Even if we look at, say, the ES from last week, or not from last week, from a couple of weeks ago, we can see that when Powell decided to speak, which was roughly here, okay, ignore this. This is just a punt of a little stupid paper trade that I put on. When he said here that his base case wasn't a soft landing, we saw the reflexivity kick in because the market here had priced in cuts. The market had priced in peak rates for roughly this period. When he said that, the market absolutely tanked. And we saw the extent to which the surprise or level of surprise affects the market massively. This is something that you always have to be factoring in, especially as we're moving into the rate cut cycle. How much is the market pricing in X event, but how much is X event surprised by Y data point? Okay, always focus on that. And then the big determinant is how long do you have to action that idea? If you've got a longer time to action that idea, that's perfect. If you don't, then it's more event driven, it's more intraday, intra-week. Then you have to be a little bit more nimble, have the position size a little bit lower. But these are always things that you can be looking out for. How much is the consensus disturbed by recent data point? How much surprise has been brought into the market?